Good morning, good afternoon, and welcome to today's webinar. My name is Jacques Bochon. I am the CEO of Halborn, and Halborn is a cybersecurity services company which is sitting at the crossroad between DLT technologies and Web2 technologies, as well as traditional finance and Web3 fintech institutions. And today, the topic we would like to talk about is how the blockchain technologies is fundamentally transforming the financial market infrastructure and what are the consequences of that transformation for the banking industry more specifically. And I will not be doing that alone. I am together with Dave Schwed, who will come on stage very soon. Dave works at Robinhood, and Robinhood is also sitting at this intersection between fintech, Web3, traditional finance, with a clear, I would say, a clear vision of enabling the access to different products of the financial institution, of the financial industry, be it in crypto and in traditional finance. But with no further ado, Dave, welcome, and I will let you introduce yourself to our audience.
Yeah, thanks for having me. David Schwed. I am the CISO over at Robinhood, supporting the brokerage and the money and banking businesses. My crypto life has started back in 2018 as the Chief Security Officer for Galaxy Digital, and I also worked for Bank of New York Mellon as their Global Head of Digital Assets Technology.
All right, so very welcome. So I think we are having a very good partner with you, Dave, today to speak about that transformation. So, you know, when we look at the last 10 years, it's really mind-blowing what happened. So Bitcoin was initially a decentralized, single-threaded experiment. Then we had Ethereum with a smart contract. Then we had initial coin offering, decentralized finance. And we come to a real full stack of technology with bridges, with Oracle, with software development kit, with a virtualized environment, with a virtual environment. And now, really in 2025, an adoption by financial institutions at scale. So it's not really a technological evolution, but it's really a structural shift in the way values is getting moved and transferred. So we see a world where those intermediaries are getting perhaps a little bit squeezed in the middle because on-chain transaction with enable immediate settlement or within a few minutes with very low transaction costs. And even more importantly, you have two rock stars on stage in 2025, which are stablecoins on one end and tokenized real-world asset on the other end, whereas the two are tightly intertwined because, of course, transaction of tokenized asset are very much facilitated thanks to stablecoins. So what we are looking at in this conversation between you and me today is much more than the future of finance. It's actually already happening and it's reshaping everything you and me we did know about. So, but when you look at all that, this history, when you look at the position in 2025, what is driving this DLT adoption? What are some of the key examples of this adoption? I have been personally, maybe to add a little bit of colors to my question to you, I have been really thrilled to see that if you take 100 publicly traded companies, they hold Bitcoin in their treasury for a value of 80 billion. And if we take all the public and private companies together in treasury now in 2025, they hold 3.2 million of units, which is 15% of the total supply of Bitcoins. So it's really mind-blowing, Dave, don't you think?
I do. You brought up an interesting point when you said two rock stars and you said stable coins and real world assets. And interestingly, neither one of these two are new. You're talking about fiat and you're talking about assets that live off chain. When you look at DLT, what is transformative is the ability to wrap some of these existing asset classes with newer technology that allows for things that would not have been able to happen previously without a lot of these intermediaries coming together. So for example, intraday liquidity or T0 settlement. We've just recently hit, in the last couple of years, T1 settlement. And that was a fundamental shift in our financial markets. You sell an equity, and the transaction will clear and settle, and you'll receive your funds the next day. But we're entering in a world where we can take those same assets, and then we can have instant liquidity, and then being able to redeploy those funds. So that is the transformative nature. But I think it's interesting, or it's important to break out the asset class side of DLT as well as the technology side of it as well, because I think a lot of times we somewhat conflate the two. When we have Bitcoin and we have Ethereum and we have Solana, and we have all of these other tokens, but then when you start talking about the stable coins and the real world assets, the benefit to that is really that DLT technology wrapping existing asset classes and existing instruments, as opposed to completely new asset classes. So as we have the conversation, I definitely want to make sure that we touch on both of those.
Yeah, absolutely right. So okay, so that's a good for stepping into this core topic. But how would you qualify or describe the key blockchain elements or features of the technology now, back to your point, that empower those new class of assets and that empower those incredible progresses of DLT within banking? What are they?
Yeah, if I had to, iron it down to or limit it down to one or two, it's definitely the programmable nature, and the openness and transparency is one side of it. You can see what's going to happen with that asset class. If you're sending an international wire payment today, there's a lot of private things that are happening, and there's a lot of trust in different financial institutions, which is why it could take sometimes 3 to 5 days to settle. But with DLT technology, because of the openness and the transparency of it, you can see exactly what is happening when you're transmitting that transaction on chain. I would say the other side of it is the global nature of it. If I had to call out similarities, it's very similar to making a phone call today. You have multiple different phone carriers throughout the world that all work on this global standard where they can just receive the phone call from another carrier and transmit the call. So I can pick up the phone call in New York and call somebody over in Singapore, and it can transmit that voice over 3 or 4 or 5 different carriers. It's the same thing if we start thinking about this global nature of financial markets, where we're going to have this interoperability, this global ledger that we can just make transactions, and then just have those on and off ramps in different jurisdictions. So I would think those are the two that I think are the most transformative.
But let's stick to the phone call for a while. Let me challenge you, Dave.
Okay.
I agree with your description, but for me, the phone call looks much more like TradFi, because every operator is taking its toll at each of the steps of that phone call. And isn't it the key difference of the DLT technology? The fact that we have this transparency, this low transaction cost. How would you speak about that?
Sure. Well, even with DLT, people are not doing this for free. There's definitely, those that keep the network up, miners, and you have proof of work and proof of stakes. You have validators and you have miners, depending on which layer one we're talking about. So I would say those are somewhat equal to the phone carriers. They're providing the infrastructure to allow the passing of the transactions, just like the carriers are allowing for the passing of the phone calls. So there is still this, monetary benefit that those that are keeping up the network, just like the phone calls. But I definitely see your point in the sense that it's anybody can participate in this new network. So the similarities are more around the passing of the calls, through global standards. But you're right in the sense that we're not now limiting to 4 or 5 or 6 major, telco providers. Anybody can stand up a validator, anybody can stand up a miner and participate in this network. So I agree.
You don't have those big centralized entities dictating their rules. So I was also thinking about what are the key differentiators. So immutability, of course, of every transaction which has been logged. And I was also thinking about 2 things, and I would be very keen on getting your opinion about that. So the first thing is this notion of composable protocols, the fact that you really combine different smart contracts as building blocks to create, I would say, a sort of bundle of different financial solution. Okay, so lending, staking, insurance, which is one thing. And also more and more, this notion of ZK proof, that's more technology in that case. ZK proof roll-up technologies which enable really a high level of compliance and while keeping speed. How do you see, where is the limit in all those evolutions?
Yeah, I mean, you hit on, when I mentioned earlier programmable, we're diving now into some of those things, and they're great call outs. The composability of, a decentralized, application, if you will, allows for, these operational efficiencies. It removes the requirement of trust. You can have trustless parties that are engaging with each other, and you don't have to necessarily put your trust that there's going to be repayments of collateral, right? You can have your collateral locked up. You can see the collateral. You can see the code that protects your collateral and the payment, if certain conditions are met. So it allows parties to interact with each other without, going through that trusted third party. And then, the other side of it, the ZK proofs is very interesting. And the one point before we get into ZK proofs is, I think part of the problem of that's somewhat limiting the proliferation is the complexity in the technologies. When we start talking about zero knowledge proofs, outside PhD mathematics, it's really just this like black box of feature that I think most people aren't necessarily understanding how it works or how to get comfortable with it. So I think as an industry, we have to start talking more about feature benefits and not so much about the technologies. When we start talking about multi-party computation and HSMs and ZK proofs and snarks, I think it just confuses the non-technical folks. And I think we have to talk about this technology more around features and benefits. So I love ZK proofs. I think they're absolutely amazing from a use case perspective. The one thing when I try to talk to somebody who's not technical, how to understand the use case of it, forget how it works. We'll leave that up to the PhD mathematics, to trust that these things are fully tested, and to, obviously companies like Halborn, to do their auditing of these smart contracts. But if you look at the feature benefit of it, you're looking at, I apply for a mortgage today and I have to send over all of my net assets over to prove that I'm able to, take out this mortgage. Well, let's just say I'm taking out a $500,000 mortgage, and let's just say, knock on wood, I'm worth, $100 billion. I shouldn't need to prove that I have $100 billion. I should only need to be able to prove that I meet the requirements in order to pay back that loan. Well, with a, zero knowledge proof, they can request that information, and I can provide attestation that I meet the threshold in order to meet that mortgage without providing that underlying information. So number one, it is providing only the relevant information, and I'm not even providing the underlying information. I'm just providing the proof that I have what is needed in order to take out that loan. So you're talking about, from a privacy perspective, you're talking about, now we're getting back into traditional cybersecurity from a data leakage perspective. You're protecting people's assets, you're protecting people's information. It's more private. And on top of that, you have this demonstrable proof that you have those assets, as opposed to just sending over a bank statement and having an underwriter look through that information.
I agree. I call that a validated tick in a box, actually, without knowing what that tick in a box really means. And I know we are dwelling long on this introduction, but I think it's very interesting. Last question for you. You know what?
Yes.
When I think about product delivery for financial institutions, I would say that the fractional ownership of security is one of the things that impress me the most, which is also enabled thanks to a DLT and blockchain. What does that trigger in your mind?
If you go back to, I don't want to say the origins, but if you go back to like the core sentiment of, why DLT, was really born, it aligns with the vision over here is democratizing finance. It is, somebody wants to get access to, particular equity, but they don't necessarily have the funds or the means to buy, whole shares. So this is allowing people to participate, to grow their net worth, to grow their wealth, to understand what it's like to invest, but not necessarily have to, buy, one share that's worth, a few $100s. You can buy fractional share and still get exposed, and the benefit of owning equities.
And I would say the majority of people can only afford a fraction of a Bitcoin, by the way, at the current rate. So I think I fully agree with that. We will move to the next chapter, which is about regulation. Fascinating topic as well, regulation. But before I do that, I would like to remind everybody in the audience that at the end of the session, we will have a Q&A session as well. So you will be able to ask a question directly to Dave or to myself. So regulation is it an enabler or an obstacle? Let me ask you just like that, Dave.
Yes.
Enabler or hurdle?
Definitely more on the enabler side. In order to, again, to have this proliferation and, complete paradigm shift in financial markets, we do need regulators to give those guardrails and give that framework and how to use it safely. I think that we need to understand the role of the regulator. Part of the role of the regulator is to provide that safety and soundness in our financial markets. And the way they do that is through legislation and through regulation on how to safely and securely implement these new technologies. So I think it's more of an enabler. Now, I think there's frustration from the wider community about how long it's taking, and some of the perhaps some folks think that it's too vague, and it's not going far enough in certain areas. But again, this is trillions and trillions of dollars, or potentially even more, as we start talking about more equities and debt. We're talking, like I said, about $200 trillion. So I think they're taking their time, and I think they're doing it in a safe and secure manner. So I think it's an enabler.
All right, so I agree, but if we look at the regulation, I see some gaps, and for me, there is one thing that absolutely needs to happen, and I don't know what will really happen in the US at the end of this year. And I am not thinking about the Genius Act. We'll come back on that later on. But I'm thinking about this equivalence between tokenized asset on chain and the real world asset. I am Swiss, so I know that in Switzerland, the DLT regulation has solved that. But MiCA in the EU has not really, is a little bit ambiguous around that. How do you see that?
I agree. And I think part of the challenge is understanding, there's so many complexities that I think we need to think through before, I don't want to say before legislation is passed, but to think through in order to set up those proper, frameworks. When we start thinking about on and off chain reconciliation of these assets, some of the questions that I think are somewhat unanswered or vague are, what happens if there's a legal challenge? You have a token that's sitting on chain in a jurisdiction that a court doesn't have jurisdiction over, but the real world asset is sitting, in a different jurisdiction. I think there are some things that we have to iron out before, this really takes off. So that's why, we're seeing real world assets, but in very specific, portions of the world, and definitely ring fest from a KYC perspective in certain jurisdictions.
Yeah, KYC and anti-money laundering. I think those are two things which are deeply embedded in all those new regulations. Do you see that likewise?
I do. And I think, what we're going to end up seeing is we're going to see perhaps, walled gardens of KYC, KYC, slash AML, travel rule. There's a bunch of regulatory frameworks that I think we're going to end up creating. I don't want to say a shadow, but like financial markets that have gone through this KYC AML approved regulatory framework. And then we'll also obviously have our, just decentralized, ETH, Solana, Bitcoin for those regular transactions. But we will see this parallel financial markets in the DLT side.
Yeah, that's right. So speaking about technology a little bit more at this stage, so we have MiCA, which came into force in Europe, in the EU in February, but we also have DORA, which is all about digital operation and the regulation and the resilience of it. How do you see those two things coming together? Do you see contradiction? Do you see coming hand in hand? What's the thinking at Robinhood around those two things? Technology and the regulation of the market, financial services market itself.
Yeah, I think they're both, great step forwards for crypto. I think, on one hand, providing that, here's the path forward for certain digital assets, with MiCA. And then from a DORA perspective, talking about operational resiliency for organizations to make sure you get that safety and soundness. So on one hand, it's here's what you can do, and here's the proper path in order to do these certain things. And then also from a operational resiliency perspective, here's how we can ensure that those clients and retail and institutional that are partaking in these approved on MiCA are done in a safe and secure manner. So I think they're both complementary and very forward-looking.
Okay, so you are not challenged at Robinhood with those two things, so you can cope with both.
Yeah.
All right. Interesting. So stablecoin. We said we have two rock stars. One was tokenization of real-world assets. The other one are stablecoins. So stablecoins are interesting. So if we look at the MiCA regulation, you need to have 70% in high quality governmental bonds as reserve, which is really pushing then stablecoin to become almost something institutional, okay? And yet we still have on some central bank's corner those initiatives around CBDC for wholesale. Do you see that converging at some point?
I think they're two different use cases. I think CBDC is more, I would say, central bank to bank, type of liquidity.
Yeah, wholesale then, yes.
Yeah. I don't see, in the immediate future, from anything that I've read or discussions that I've had, CBDC, going, directly to retail. I think it's, again, central bank to bank. But I think the stablecoin is very interesting in the sense that it allows for, that's, again, it's in the name, stable coin, that is tied back to an asset, and you have this ability to do that, T0 instant settlement, and not have to worry about the, the fluctuation or the, the volatility in, holding Bitcoin or in holding ETH or Solana or any of the other layer ones. So we're able to participate in this, DLT backed financial markets infrastructure and being able to, settle in native assets, digitally.
And do you think that stablecoins are in fact accelerating a trend, which is the following? For me, you spoke about those layer one tokens like Bitcoin, Sol. They are pushed more and more towards the security type of things, whereas stablecoin would be more of a currency. Is it a fair statement?
I think that's a fair statement. I think what it does is it also keeps liquidity on chain. So if I want to, take profit on, the rise in Bitcoin, and I don't want to have to exit it into fiat, I can just, quickly swap into a USDC, hold on to it, and then redeploy my USDC and, buy something else or, participate in the liquidity pool. So I think what it ends up doing is just it keeps those assets on chain.
Yeah, and the pegging makes the transaction. So it makes, in fact, the tandem of tokenized asset and stablecoin a kind of winning coalition. Is it the big thing that will continue to drive the transformation of the financial market infrastructure? What do you think?
I think so. I think, providing, using stablecoins and crypto rails, I think is really going to be one of the non-sexy part of crypto that, those that are not part of banking or for the financial markets really truly understand and grasp. But when we have the ability to, pay out, an Uber driver or, somebody working in hospitality on a weekend and being able to pay them over the weekends because we have the ability to do 24/7 settlement. Again, it's going to be dollars to them, but the entire transaction from a crypto rails perspective will allow that, settlement on Saturday instead of having to wait until, next week for, for that ACH payment into their bank.
Yeah, which is exactly the vision of the initial vision of the initial 2008 white paper. So it's cash from hand to hand, secure and pegged in that specific case. All right, so let's switch gear now. Let's speak a little bit about the rising threat landscape. Okay, so what we think at Halborn is that this evolution since 2008, the initial white paper and Bitcoin, 2015, Ethereum, and the first, I would say, virtual EVM, the virtual environment to develop application, the smart contract. And today, where we are bridges, we have oracles, we have software development kit, we have virtual layer. So the level of complexity has been multiplied by 100, most probably, but also the attack surface and the potential kill chains and attack vectors. And what we have seen just over the last 10 years is that the top 100 DeFi hack have generated close to 11 billion of losses. And those losses, by the way, we just published a report today. You will see that we will have a banner showing up soon. So big losses, but also an acceleration. Just in this year, we have two fantastic or terrible headlines like the Bybit case, $1.4 billion that disappeared in February, but also the Coinbase insider breach, 400 million in May of this year. So a lot of headlines and attacks vectors, kill chains, compromised developer account, DNS hijacking, leaked credentials, social engineering, spear phishing, deepfake, all kinds of attacks, which makes, in fact, the vulnerability, so the attack surface of those stacks we were speaking about, a combination of Web 2 and Web 3. Actually, out of our report I was referring to just before, 55% of the volume of money which was lost was due to off-chain vulnerabilities. So we have gone far beyond the smart contract bug, which was a big thing back in the day, and we have moved really in a world where the threats are, I would say, shape-shifting and are covering this entire stack. So when you look at 25, again, above and beyond the few cases we mentioned already, but which are already staggering, okay? So how do you see that threat landscape evolve? And what would you do and what are you doing in your role to face it?
Yeah, good question. It's definitely it's scary, but it isn't. When you think about the attacks that have happened, I think a lot of it comes down towards poor cyber hygiene. It comes down towards earlier stage, organizations. And again, I'm not saying all of them, but earlier stage organizations that don't necessarily think through security from an enterprise perspective. When you look at larger organizations that again have the budget and have the resources in order to stand up proper security frameworks, proper CI/CD, proper SaaS and DAS scanning, engaging with firms like Halborn for those external assessments. I think you'll notice that there's a lower likelihood, if you will. I'm never going to say that there's a zero chance, for any organization, and including governments and large enterprise organizations. There's obviously always going to be threat actors that have the will to find their way in. But what you end up doing is you either prevent it, you reduce the blast radius, you have these circuit breakers. So I wouldn't say that any organization is necessarily impenetrable. I think it's around having those proper preventative and detective guards in place and having that proper framework. It's not just around technology, it's also around people and process. If you look at the construct of like a large financial services organization, you have the 3 lines of defense: your first line of defense, second line of defense, and third line of defense. And those are put in place to ensure that there's multiple eyes that are looking at different projects before they go live. So I think, yes, the threat landscape has definitely increased, and we see, a shift, I guess, if you will, of sophisticated threat actors that are now targeting. But I think they're targeting for 2 reasons. I think it's one, that immaturity in some of the earlier stage organizations, that they're targets for these sophisticated threat actors. And I think the bare asset nature of some of these assets, Bitcoin and ETH, and stablecoins in some respect, outside of some that could potentially be burned, are bare assets that are just inherently worth certain money. When you start talking about real world assets and you're thinking about things that are pegged to something that is off chain, I think you're going to see less of issues in those areas. So I think it's more around the native asset side, but I think it's definitely solvable.
Yeah, no, I agree, because the key thing about, I come from the traditional cybersecurity environment. And in that world, when you have a ransomware, you still have multiple hours to react. And today, by the way, ransomware are made through data leaks and not so much through deploying software into your environment to freeze everything. So things are changing. But in the case of on-chain vulnerabilities and on-chain hack, what is really terrifying is the fact that once they are in, they are gone with the money. And the Bybit case is, of course, I would say, a typical paradigm of that difference between those 2 types of environment. And you don't have that much of an orchestrated response capability in the case of on-chain. How do you deal with that at Robinhood? This difference, And again, I understand that the attack surface could come through Web 2, could come through compromised developer accounts, as we have seen in many cases from the past. But still, when things are getting on-chain, you have this kind of immediate, it vaporizes immediately. How do you deal with it?
Yeah, I think it's, if you, again, like look at the report that you just published today, I haven't read it yet. Obviously, you just published it, but I'm going to take a look at it. But if you look at those hacks and you deconstruct them, those are learning lessons for organizations. I wouldn't talk negatively about it, any institution itself, but if you deconstruct these attacks, you'll see clear vectors in that could have been either prevented or detected much quicker. So I think it's around the market, if you will. I don't want to say growing up, but again, you have traditional financial markets where you have large, globally systemic important banks and financial services organizations that have had the benefit of being around for 30, 40, 50, 100 years, 200 years, and really understanding like how to actually manage risk in a very structured way. And then you have this new world that is 10, 15 years old at most, and we're still figuring things out. There are certain areas where there maybe aren't certain tools that maybe weren't available 5 years ago. So I think that side is learning from this side, and I think we're going to get to a point where we'll have that safety. You don't read about banks, if you will, getting hacked every day in the news like you do,
No,
and
thanks,
unfortunately
good.
in crypto. Yeah, exactly.
But let's speak about banks. So you used to work at BNY Mellon. So the notion of custody, you know very well. Okay, and we also see in this report that you were mentioning from Halborn, the top 100 hacks, that 91%, I think, of the money that was stolen was due to hot wallet hacks, in fact, or vulnerabilities. So now banks, thanks to the new legislation, specifically in the US as well, they can go at full speed and full-fledged custody for crypto assets. What do you think are the key things they are doing to make sure, next to working with Halborn, of course, to make sure that their custodian operations are safe?
Great question. And I think when you think about custody, there's two areas that I would call out. One is the keys, right? Like that's generally where most of the conversation lies. Are you using MPC, multi-party computation? Are you using HSMs? Are you using a mix of the two? If you are using HSM, which HSM, which FIPS, certification? If you are using MPC, which specific protocol? Where are the keys? There's so many underlying questions that I think we're finally figuring out what works, doesn't work, where the vulnerabilities are. But if you look at, I'm sure in your report, you'll probably see that, most of these hacks, when we start talking about like enterprise level institutional custody, are not happening at that level. No one is breaking into HSMs and stealing keys. Outside of theoretical MPC vulnerabilities, we haven't seen an NPC, knock on wood, NPC, vulnerability itself that has left the funds. It's the theft when it comes to custody has really come to maybe theft of secrets, API secrets, because you have to remember, the entire chain of custody isn't just where are the keys. It's how are you instructing where your keys are stored to sign those transactions, and that's where we see a lot of the issues. Because when we start coming into like policy engines, what can sign from a hot perspective? If you're an exchange, you can't have cold signing for every transaction because you need to be able to, answer clients that want to send funds in and out programmatically. So you usually have a policy engine that states, up to these types of size of transactions are programmatically signed. Well, if you're going to programmatically sign it, that means there's technology somewhere that is taking a transaction, that is validating the transaction, that is authorizing the signers to sign. That's usually where we'll see those issues. So I think that's the attention that I think most organizations should be and are focusing on. I think I don't want to say solved, but I think we've pretty much ironed out what does the storage of keys look like. I think it's shifting left, if you will, is where we should be focusing our attention on.
So in fact, what you're speaking about are core processes for custody and standard operating procedure, and they need to be robust and they need to be assessed. And we need to apply most probably also multiple eyes principle to those to make sure that best practice sharing within that industry, not only within the hackers, but also within the good guys is happening. So I think it's a great point. So let's move in that conversation because it's so interesting that we are dwelling too long. But let's speak real quick a little bit about what I call gold standard. So I would say the following to introduce that topic. First and foremost, there is no such a thing as a gold standard in terms of cybersecurity for the Web3, DLT, you name it, blockchain technologies. okay? Unlike in the Web2 space, where when you combine ISO 27001, NIST 2 for critical infrastructure, and you put those things together, first, they are extremely well aligned, so you don't have a big jump to move from one to the other. And second, there is a broad adoption in financial services institution. And if we look at Web3 from our standpoint, you have an extremely, I would say, fractional environment where you have BSSC, you have the cryptocurrency security standards, you have plenty of things. And by the way, Halborn has also released, we have released cybersecurity standards following a little bit the lead of the CVE in the classical cybersecurity called blockchain security standard, BSSC, which enable us, in fact, to provide a framework based on nature of the exploit, the risk, the scope, and how we can recover from that exploit. So we are very active in that space. Do you believe that we will see a convergence at some point there, and we will see one of those big institutions, one of those big committees harness that and impose something? I'm thinking NIST and CVE. How do you see that?
I think we'll head there. I think there is still somewhat of a knowledge gap when it comes down towards who is I don't use the word train because it's not even a training issue, but who is capable of writing these standards? Because it's not just a innate understanding of the technology, it's also understanding how to write frameworks. It's also understanding enterprise level technology. So I still think we are earlier in the sense of the pool of people that really truly understand the technology that can help and provide these standards. But I think we'll get there. I think NIST is probably where I'd want to see ultimately the great work being done by the councils and C4s from this. So I would love to see NIST use those as the genesis of what will ultimately be a framework. Because if you look at the NIST cybersecurity framework, it is a framework that's used by every industry, and it provides, again, it's not very prescriptive in the sense of here's what you have to do per se, but it does give you those design principle based on how to design a security program. And then what ends up happening is you have auditing firms and you have regulators that will then use that framework when they're coming in and providing an assessment of an organization. So I'd love to see something come out of NIST.
Yeah, and it's a real compass, to your point. Really providing the compass to the people like you, like me, working in this industry. Okay, let's switch gear and move to the last and final chapter before we come to a conclusion of our conversation, which is future-proofing digital finance. And this is what we are talking about, digital finance. So if we make a small recap, so we have regulatory clarity, which is no longer a distant hope, which is really coming down the road. It's arriving fast. And in that context, it means that the adoption will accelerate, that the banks will all play custodian for those digital assets, that they will all start to generate and issue tokenized asset on chain, and so on and so forth. So at Halborn, we believe that cybersecurity should not be any longer an afterthought, like those famous smart contract assessment, but should be shifted left, really as a secure by design approach. And that's really a kind of mantra we have adopted at Halborn, secure by design, where right from the start, you have a DevSecOps mentality or culture on the entire environment, meaning that we follow the software development lifecycle of all those fantastic financial services initiatives, where we are integrated securities and integrated component of the CI/CD process when we speak about standard operating procedure, and where, in fact, everything else which come at the end is just to test, like pen testing, smart contract assessment, to test something that should have been designed in a robust fashion. So that's what we think, and we believe that could really enable this new digital transformation of the financial institution. And we believe that institutions that embrace that shift will have a much more secure, I would say, foundation to adopt those technologies. Now, after this long introduction, Dave, in your mind, what should be the CISO top priorities to make sure this thing is happening? And those platforms are as robust as it can be, as resilient, as it can be with regard to the cybersecurity threat landscape.
Yeah, I think your term secure by design, I think is probably like that's that North Star that's where you should be aiming for. A lot of organizations will look at security as like an internal, even internal security teams as like a internal service provider to technology. Let technology do their thing, and then security comes in and kicks the tires and looks at it after the fact. While that works, it's not ideal. It is that secure by design. It's security embedded with technology to help them build. Because if you start looking at, what we noted earlier, some of the features of this it's the immutability. So due to the inherent nature of the immutability of these transactions, we have to make sure that these things are done in a proper and secure manner. And really, the only way to do that is to take the folks that really truly understand security working alongside technology. So when it's when we say shift left, it's even lefter, if you will, than working with developers and engineers. It's working at the product stage. We're thinking about doing blank.
Design, architecture design, in fact, right?
Yes, exactly. That's where security should be involved.
Yeah, that's really exciting, Dave, and I could not agree more. Right. So maybe as a last comment from my side, it's a kind of almost non-disclosure, but we are working. We spoke a lot about compliance. We spoke about the gold standard. We spoke about the regulation, and you use this word jurisdiction because, in fact, that's right. Compliance on one hand, but regulation, it's really linked to a territory, to a place, to a continent, to a country. So we are launching very soon what we call a compliance pilot to help CISO, people like you, really comply with the local jurisdiction and have, in fact, all the best practices I would say embedded into a dedicated agent to help you guys. So that's really one of the big things we are working on, combining, I would say, decentralized ledger technology, distributed ledger technology, and the power of AI. Right, so here we are. We have arrived at the key Q&A session from the audience. So let's have a look and check if we have question from the audience. Let me have a look. So let me pick that one. How do you see AI complementing DLT in transforming banking operation? So this notion of AI and DLT. By the way, before I hand over that question to you, Dave, I was in ETHCAN last week, and the big thing was decentralized AI on Ethereum mainnet, to make sure that no single institution or companies control a centralized AI agent. So, but back to the question, how do you see that happening? So this combination of DLT and AI, and what are the thoughts you have at Robinhood? What are potentially the initiatives?
Yeah, when you look at AI, it's viewed as this, silver bullet that's going to fix and solve all of our problems. And I think just like DLT was 10 years ago, I think we have to really think through what is, number one, the proper use case for the technology. Where does it sit? What are the proper safeguards? Just like we did with crypto. We can't just, flip a switch, turn AI on and say, go do the thing. It's, where are your models sitting? How are you training your models? When we start thinking about prompts, how are you protecting your prompts? How are you testing your prompts against, gradient attacks and certain prompt injections and LLM poisoning? So I would say, to me personally, I think, it's still earlier stage for many organizations when they are starting to think about like where to utilize AI in a truly agentic way. But I am very, very excited about it. And I think, whether it's, 12 months, 24 months, 36 months, we will get to a world where large portions of our operations are completely replaced, by AI or, severely augmented. So I think we're earlier stage, again, when you start talking about larger financial institutions, from them using it in a very meaningful way. I think right now it's more of, please summarize blank and please do some research, as opposed to, hitting a switch and saying, completely, automate this function.
I agree, and I agree it's early stage, and I agree that our traditional financial institution will have a lot to digest, which lead me to the last question, because we have to come to the end of that fascinating session. Again, Dave, thank you so much for that.
Yes,
This one is a good one. I love it. Okay, so you have a lot of legacy systems in banks. You still have mainframe, program COBOL, as we all know, we both know at least here, okay? So if you have to move into the decentralized distributed ledger technology, okay, how do you do that? How do you make sure that those two things are interoperable? So what would be your piece of advice?
My piece of advice is not necessarily to think about ripping and replacing at the moment. I think it's around foundationally building the right platforms that will service the large financial institutions. So it's thinking about from a turnkey self-service into, like, if you're talking about a large bank with hundreds of thousands of employees and engineering departments of thousands of engineers, you want to be able to give them the tools to utilize the technology in a very meaningful way. I think it's not advantageous to sit down and say, okay, I'm going to replace this and I'm going to replace this. It's giving the engineers, the product people, the tools in order to build. Yes, there's going to be rip and replace of some existing systems once we truly understand what are those going to be, those efficiencies. Again, it could just be an internal ledger with smart contracts, so you can create that attestability to a regulator. When regulators come in and they're asking for evidence, how do you know that the number here in this ledger system is accurate? If we just replace that entire operational flow with DLT, and we can show transactions and key signing and cryptography to show that the data in this system is accurate because of DLT, I think we'll start to see a lot of operational efficiencies there. But I think the twofold would be, one, operational efficiencies within the organization would be like where I would focus, but then two, making sure you're building those foundational turnkey self-service systems for engineers.
Thank you, Dave. All right, we come to the end of that session. I would like to thank you again for your time, Dave. I think we had very great insights from Robinhood and from yourself with your broad experience. And I would like also to thank the audience for attending today, and wish you all either a very good morning or a very good evening. Thank you so much.
Thank you for having me.